Hi, Steve Schlegel here. I'm sometimes asked whether it's better for a small business owner to keep their car in their individual name or purchase the vehicle inside the corporation, have the corporation buy the vehicle. And we'll use the example of a car here, and we'll say that the business is owned in the corporate format. And so if the corporation owns the vehicle, of course the corporation can deduct all the costs of maintaining the car, the fuel, insurance, and so forth. And in addition, they'll be able to deduct depreciation against that vehicle. Now, depreciation can be limited. There's special rules on how much depreciation you can take on any one year for a company vehicle. But even though there is that limitation, you do still get to depreciate it. Second point on the corporation owning it is the owner needs to keep track of their mileage. Just because the company owns a vehicle doesn't mean you don't need to track your mileage. So unfortunately, you still need to do that. And the reason is that unless the vehicle is used and can be proved to be used 100% by the business, there needs to be an allocation. So if the business owner is using the vehicle 10% or 20% of the time for personal purposes, then the value of that use gets put on the owner's W-2 at the end of the year, and they have to pay tax on that. Third item with regard to the corporation owning the vehicle is because the vehicle will be insured with a commercial package, sometimes the vehicle insurance is more expensive inside the corporation, but it can depend on your own driving record and where you live. So you'd have to check with your insurance agent to determine whether that's better or worse. Now, the alternative, instead of having the corporation own the vehicle, is for you personally to own the vehicle and use it in your business. When you do that, and if you track your mileage, and again, you have to unfortunately track the mileage, but all of those business miles that you incur can be reimbursed by the corporation to you. And let's say the reimbursement rate for the year that you're dealing with is 55 cents a mile, which isn't too far off of what it is the last few years. At 55 cents a mile, if you had 10,000 business miles, the company could write you a check for $5,500. The check that you receive is income tax free to you as long as you've reported those miles to the business, and the corporation gets to take a deduction for it. So corporation takes a deduction, saving you some tax, and you get that check tax free. So that can be an advantage, and the insurance oftentimes is less expensive as an individual than it is inside the corporation because you don't necessarily need a commercial policy for some of the use of your business vehicle. But again, talk to your insurance agent to find out what makes sense from an insurance perspective. So bottom line is if you put a lot of miles on a vehicle like a car, oftentimes that mileage deduction and owning that vehicle individually can be worth a lot more to you in the long run. And so if you were putting on 30,000 miles a year, that's over $15,000 that the company can reimburse you. Company gets a deduction and it's tax-free money to you. So that's quite a benefit. On the other hand, for vehicles owned by the corporation, especially heavy, what's called, quote, heavy vehicles, large SUVs and pickup trucks and so forth, may be eligible for some Section 179 deductions, get a little extra depreciation right out of the chute. But you need to balance those out, and you should certainly talk with your CPA about it to see what makes the most sense. But in general, for a typical vehicle and not a heavy vehicle, if you're putting a lot of miles on it, I'd really recommend you look at that mileage deduction. It could make a lot of sense for you. Thanks for listening. Steve Schlagel.